Cool. Hi, my name is Felix Leupold.
Hey,
You've introduced me already? Sorry, I'm not sure.
I'll go ahead and introduce you. Yeah. So welcome back to the 2023 Hack Summit. I'm Ed Roman, and I'm here with Felix Leupold from the Cow Protocol. We're big believers in what Felix is building at the Cow Protocol and Cow Swap. We think it's a revolutionary way to basically perform exchanges of assets in Web3, and we think it's going to be very transformative in the long run. So this is going to be a very educational and informative talk that Felix is going to give, and Felix, just take it away at your convenience.
Cool. Thank you very much. Yeah, today I want to talk about basically what we think is the best way for DAOs, decentralized autonomous organizations, or just institutional fund managers in general to manage their treasury by trading through Cow Protocol. And my talk will focus mainly on what are the advantages of Cow Protocol for these types of traders. And then, yeah, that will basically be the focus of my talk. However, maybe to give a little bit of an introduction, thanks Ed already for mentioning what Cow Protocol or Cow Swap is. Just for the people that may not know, if you've heard of Cow Swap, then basically Cow Protocol is the trading mechanism that is powering that exchange. Cow Swap, as you can see in the picture here, is a swap UI that is very similar to what you might be used from Uniswap or your favorite DEX aggregator. But we have the aspiration to achieve best possible prices on chain, better prices than you can get in any other DEX mechanism through a couple of different things that we apply. The first and probably most important one is that we batch orders together and then auction them off for settlement via a so-called solver competition. The advantage of batching multiple orders together into a single auction is that it allows for what we call coincidence of wants. That's also where the name Cow Swap and Cow Protocol comes from. And what a coincidence of want basically is if I'm, let's say, selling Ether for DAI and somebody else wants to buy Ether with DAI around the same time, then instead of sending both of these traders to decentralized exchange where they pay liquidity providers a fee, where they pay price impact, we can just settle those trades directly peer-to-peer. That is a coincidence of wants. And then the other thing that is unique is what we call solver competition. So for each auction, there is a network of decentralized matching engines, if you want to call them like that compete for getting the right to execute trades. And the best solver is then awarded the privilege to settle a transaction. And so this is how we can achieve structurally better prices than any other DEX aggregator or DEX out there. We also think that we are the safest and easiest way to trade for people that might not want to deal with the complexities of on-chain trading. First and foremost, we protect our users from the dangers of the dark forest, namely MEV, maximally extractable value. I'll give a little example in the talk on where MEV actually hurts traders the most. But you don't have to worry about any of that when you're trading on Cow Swap. It also allows for ETH-less trades. So whenever you place an order on Cow Swap, there's no necessity for you to pay gas, to pay ETH and leak your precious ETH in every trade you do. Instead, the fee is fully taken from the sell token. So you're just spending a little bit more of the token that you're already trying to get rid of. And then last but not least, you as a user don't carry any revert risk. If for whatever reason the trade doesn't go through, the price moves against you, or you move out the funds or cancel the order, then there's no cost on your end, and yeah, basically you have none of that risk. But today, really, my focus is going to be on not just why Cow Swap is the best DEX aggregator for regular users, but also why it's particularly suited for DAOs and multi-signature wallets, really, in the broader sense. And the main reason for that is the way that Cow Swap protects users from MEV, and basically the upshot that MEV is particularly hurtful and dangerous for DAOs. Let me explain what I mean by this. If you haven't heard of MEV before, maybe the best example to illustrate it is through what is known as, well, slippage tolerance whenever you trade on a DEX, for example, Uniswap. You might have seen this UI before. Basically, if a user is willing to sell 1 million USDC, the UI will show them well, okay, at this point in time, we are pretty confident that we can give you some amount of Ether for it, let's say 750.623. But then what the user is actually signing off on is an amount that is strictly less than that big amount that's shown in the UI. Here in this case, I think the default slippage tolerance is something like 0.3%. So in this particular case, the user says, even if the price moves, I am happy to still accept the trade as long as I get at least 743 Ether. And the reason we need the slippage tolerance, the reason that you actually have to discount the price that you see in the UI by a certain percentage is the sheer fact that the blockchain is volatile and the ETH price in particular is volatile. And there is a time delay between you seeing the 750.623 ETH in the Uniswap UI here, and then you confirming the transaction in MetaMask, let's say, but then most importantly also for that transaction to end up being included on chain. And so there might be easily, even if you're fast, 30 to 45 seconds to a minute passing between you seeing this number here and then your transaction getting included. And as we know, Ether is volatile. So if the price just goes down a tiny, tiny bit, if you were to include no slippage tolerance at all, your trade would fail. So really that volatility and revert risk requires users to set a slippage tolerance. But then on the flip side, if the price of Ether stayed stable or even went in your favor, you basically allow somebody, and in this case, it very likely will be the validator that is allowed to produce the next block, to actually manipulate the prices and pretend as if they were moving against you. So what the block producer can do in case nothing happened, actually the price of Ether stayed flat, they can include a transaction inside the block just before your transaction that moves the price of the pool exactly to your pain point, exactly to your limit price, then include your transaction, and then eventually revert their initial front run with a back run. And you can see this, I mean, this trade was actually taken from a real world example. Here, the damage was more than $10,000. You can see this in everyday trading, on chain. It's the most, I guess, predatory type of MEV attack called sandwiching. And it's a real problem. It's a real problem for retail users, but I'll explain why this is an even bigger problem for DAOs or multi-signature. So first, let's recap that MEV is a form of a hidden cost for trade execution. You as a user have to set some slippage tolerance, and most of the time, if your trade is big enough, that slippage tolerance will be fully exhausted. Now, one might say that the easiest way to deal with this, and we don't need to spend hundreds of thousands of hours and dollars on actually trying to fix this type of MEV, would be just for users to set a very appropriate slippage tolerance, whatever that means. But thinking deeply about what is the minimum amount of slippage tolerance I need given the volatility, but not set it any higher than that to avoid being extracted. However, this argument is shooting a little bit too short, because we've seen that there is latency between you seeing a quote on your UI and your transaction making it into the blockchain, and that latency really makes slippage tolerance a necessary evil. If you set 0 slippage tolerance, you'll have a lot of failed executions. If you set a high slippage tolerance, you'll get extracted. Now you might say, wait a minute. That's clear for retail users, but DAOs have huge latencies. Any DAO that really goes through a decentralized governance process will require some form of voting period, and those voting periods can take anywhere from between 1 day to multiple weeks. I think the average or usual voting period is about 7 days. And so if you think about how a DAO can make a truly permissionless and decentralized trade, from creating a proposal, here's the trade we want to do. We want to go on Uniswap and sell 1 million Ether, 1 million USDC for Ether, for example. And then waiting for 7 days to get their entire kind of community to vote on this, the price will have changed dramatically. And so basically the DAO has two choices. Either they can set an extremely large slippage tolerance. I think the implied volatility of Ether over 7 days is somewhere way above 20-30%, which would then give a very high risk for MEV extraction. If the price stays flat or even moves in favor, there'd be a huge amount of MEV on the table. And if the DAO, on the other hand, decided to set a very tight slippage tolerance, just using whatever the price is at the day they are creating the proposal, then they would they would have a very high risk for execution failure, because if the price just moved slightly against them, their transaction wouldn't go through, and they would have to go through the entire proposal and voting period again, which is also very costly. So in both cases, DAOs really have a difficult time to trade in a fully trustless manner. So what happens today basically is that a lot of DAOs defer treasury management to trusted custodians or guardians of the treasury and let them trade basically at their will. But I mean, the D in DAO stands for Decentralized Autonomous Organization. And if we can, and I will show how we can, create a fully trustless process for making treasury management, then that is superior to relying on single people or like a small group of people to do the treasury management. And just, even if you're relying on a small group of people, so let's say you have a multi-signature wallet with 4 custodians and 3 of them can authorize any trade, you run a little bit into the same issue, because even with a safe, for example, where you need to collect 2 or 3 signatures, the time it takes for you to get all those signatures, again, won't be 30 seconds or a minute. It will be in the ballpark of maybe half an hour or an hour. And so you have this latency that is much larger and that basically requires you to set larger slippage tolerances. But let me now talk a little bit on how, what happens on Cow Protocol and why Cow Protocol doesn't have this problem, or why, I mean, basically the key message here is on CowSwap, you can set a high slippage tolerance and you'll still be safe. The mechanism basically makes it so that your slippage tolerance is not extracted. The initial process is similar. You still, for a DAO, go and make a proposal. You go through the voting period, and then at some point when the voting period is passed, the order will be placed. And then we enter kind of the Cow Protocol realm, where first we're trying to batch the orders, or your order specifically, together with other orders. We then go through this competitive search for what is the best execution path. And then the execution is taken care of by the winning solver. So let me go into these steps a little bit more in detail. The first step looks quite similar on paper. There's one very particular difference, though, in the way that orders are placed on Cow Protocol. The main difference is that users only sign an intent to trade. They only specify what is the limit price at which they want to trade the 2 assets. They don't have to at all commit to an execution path or a protocol or any kind of, saying like, oh, I want to swap on Uniswap, or I want to split it 50-50 between Uniswap and Balancer. They just say, I want to trade A for B at a specific limit price. And then also for DAOs, not so important, but for retail users, it's interesting that just signing that intent doesn't cost any transaction fees, and so it's free to sign these orders. Now then, if basically the protocol collects orders from all participants, and every 30 seconds roughly, the protocol dispatches a batch of all orders that are valid at this moment in time. And so let's say the DAO placed an order, but there's also other people trading, maybe some retail users, maybe some other DAOs, maybe some anybody that is trading roughly at the same time will end up in the same batch. And this batching allows for finding coincidence of wants, finding peer-to-peer trades. You can think of it as if you're in an airport at the exchange bureau, and you can see the price for buying US dollars with euro and selling US dollars with euro, and you actually see that gap in there. And then you assume there's a queue in front of that exchange bureau. And what CowSwap basically does, it goes with a megaphone through that queue and asks, hey, tell me what you want, tell me what you're selling, and we'll try to match you peer-to-peer to save on the fee that the market makers take, to save on price impact. So if one party is moving the price up and another party is moving the price down, that is another hidden execution cost that is not necessary if we have a coincidence of wants. And then last but not least, Executing multiple trades in a batch is also more gas efficient than executing, let's say, 4 trades individually. So there's like these are the 3 main points in which batching can save money. And maybe just one more slide to really visualize or drive the point of a coincidence of one's home and where this price improvement comes from. Let's say you have a Uniswap pool and the price of Ether right now is 1,500. So because there is every Uniswap pool takes some fee, the price at which people can sell Ether and the price at which people can buy Ether will differ. So let's say the Uniswap bid is $14.99. So a DAO would be able to sell its Ether into the Uniswap pool at $1,499. Now, let's say there is a retail user who would want to buy Ether around the same time. If they bought from Uniswap, they would have to buy at the ask price of $1,501. If they end up in the same batch, we can actually settle them at the spot price at the midpoint between bid and ask. And so we can generate a surplus both for the DAO as well as for the user and have a win-win situation. But even if there's no coincidence of ones, even if you end up being yourself in a batch, the mechanism will still protect you from MEV and make execution very easy. And that is through the solver competition that I've mentioned before. So the batch that has been created is sent to a permissionless network of bonded solvers. So the way to join this network is to post an insurance fund, if you will, a bond, and then any party can join and become a solver. Solvers will receive the batches and try to find the best possible execution for all the orders in the batch off-chain. And the thing that is important to note here is that only now we commit to a concrete execution path. So if the DAO 7 or 8 days ago decided they want to sell a large amount of Ether for USDC, they don't have to decide which exchanges with what split they want to use at that point. They can just say, here's what we want to trade. And then the optimal route is decided when it's actually time to put that transaction on chain. And that is huge. That basically makes sure that you always get the best route at the moment that your order is being executed. And so solvers then compete. Basically, everyone submits their best suggestion on how to settle this batch. And then the protocol chooses the solver that will deliver the most price improvements, on the orders. So if you were willing to buy Ether at $1,800, let's say, and a solver is able to give it to you for $1,700, it achieves a $100 price improvement. And whatever solver achieves the most price improvement gets the right to execute your trade. And those price improvements can come from a variety of sources. They, of course, like any DEX aggregator, would come from tapping into existing on-chain liquidity pools. But our solvers also, or some solvers also, integrate with private market makers. Some of them are taking cross-chain risk. So if they see Ether trades at a different price on Arbitrum, they might buy some Ether there and already sell it to you on mainnet. But that's basically up to the solvers. We actually have no idea of what mechanisms or what strategies those solvers employ. It's just trying to maximize the price improvement we can get for the user. And so then one solver wins the competition and is tasked to execute the settlement. In that moment, you will still be fully protected against MEV because solvers are bound to the solution they've committed off-chain in the off-chain competition. So it's basically up to the solver. They bear the execution risk. It's up to the solvers to set that nuanced slippage tolerance that we've talked about, just enough to not have a revert risk, but not high enough to get sandwiched. And basically solvers are professional entities, so they can assess that risk much better than a retail user or even a decentralized autonomous organization, a smart contract itself. And because they carry the risk of reversion and any type of extraction that happens, even if a solver ended up being sandwiched, they would have to pay the difference in the execution they received on chain and the execution that they've bid for in the step prior out of their own pocket. you as a user are guaranteed the price from the off-chain competition. And that's basically how a DAO can say 7 or 8 days ago, I want to make this trade. I'm okay with 10% or 20% slippage tolerance. And by virtue of having that solver competition, they will be guaranteed to get whatever is the best possible price and route at the time the trade executes. Now, we're working with a variety or with a bunch of DAOs. We are trying to increase that the amount of DAOs that we work with even more. We've been doing some research over the last couple of months and are also focusing with some features on serving DAO needs. If you are a DAO or an institutional investment vehicle that would like to learn more, or also maybe tell us something about your trading needs, please feel free to reach out to us. We are still continuing our user research and would love to hear what types of needs you have. But maybe one thing, to highlight a little bit more is a case study of a kind of very famous DAO, which made a very large trade through CowSwap that was also covered in the news, and I think about 2 months ago. ENS, the Ethereum name service DAO, sold about $16.5 million worth of ETH for USDC to fund its development for the next couple of years. And if we look at that trade, first of all, we can see that selling $16.5 million worth of ETH in one single transaction is, of course, it's a very big trade. We can see the execution on the right. It means that basically every on-chain liquidity pool that exists that has ETH USD liquidity was tapped into. It was a very complex settlement. I think the 1-inch solver won the settlement in the end. So the most important DEX aggregators are also, we have solvers that cover basically the 1-inch the 1-inch algorithm. We have a solver that covers the PowerSwap algorithm and 0x, and then we have a bunch of other solvers that try to build their own DEX aggregator algorithms. In this case, 1-inch won. It generated more than $80,000 in trade surplus. The ENS DAO got an excellent price. They were very happy with the execution. They were looking into using some other auction mechanisms potentially on chain, in which the price impact would have likely been way beyond 1%, probably maybe even 2%. So they were very happy with the price impact they received. However, of course, if you look at 0.6% was the eventual price impact. If you compare this to things that are possible on centralized exchanges, that's still something that can be improved. And so one specific takeaway from this trade was that $16.5 million in a single trade might be a notch too much, and just breaking this up over maybe 10 different trades that trade at $1.1 million over the course of an hour. So kind of breaking this large trade up into some smaller chunks would have dramatically reduced the price impact, probably down to a few basis points. Which brings me to the last part of my talk, basically looking a little bit ahead and thinking about more advanced trading strategies that DAOs can employ. And for that, I want to introduce a technical framework we've been working on, which we call smart orders, which are basically a way for DAOs, but also regular users to implement completely autonomous trading strategies through smart contracts. So at the heart of these smart orders is what is known as ERC 1271, an Open Ethereum standard that allows smart contracts to sign off messages. If it goes a little bit into the technical weeds, but if you know that your public key that you might be using with MetaMask, of course, there's a private key attached to it, and that private key can be used to sign messages. However, if you look at a smart contract, for example, a Gnosis Safe, that contract itself doesn't have a private key. So it cannot use the same mechanism to sign off messages, to sign off trade intents as your MetaMask account does. Instead, what the smart contract does is it implements a single method, is valid signature, and basically then if we want to verify, is this smart contract authorizing whatever we want it to do, we just call this method, and if it returns a specific value, then the smart contract is happy to authorize whatever question we ask it. And so in the context of CowSwap, we would ask the smart contract, are you okay if we execute this trade on your behalf. And so the smart contract can then implement arbitrary logic into whatever it wants to express as, yes, I'm okay to make this trade, or no, I'm not okay to make this trade. And so the really nice thing about ERC-1271 is first that it allows smart contracts to validate the trades it's doing at execution time. So it can defer the question, are you happy with this trade, from maybe 7 days ago when it has to make and actually place the order and cast the vote, to whenever the trade executes on chain. And then secondly, it can not just have a static limit price in there, it can involve arbitrary logic. And so this really allows DAOs to do a much more sophisticated way of treasury management, where you automatically create trades based on some types of triggers. And these triggers could be, for example, a certain block time. So a DAO could commit that every month it does a certain trade, or after a certain amount of time, if not another event happened, it will make a certain trade. It can use Oracle prices in this decision. Am I happy to execute this trade or not? Which can be useful, for example, for stop loss orders. And it could also look at its own balances and, for example, derive a trading strategy that says, I always want to have roughly 50% of value in Ether and roughly 50% of value in Bitcoin. And if the price of Ether rises, I sell some Ether. If the price of Bitcoin rises, I sell some Bitcoin. So it can really do advanced treasury management based on, blockchain observable, of course, but based on external triggers. So let me walk you through some examples. And the first one is already implemented in live, which is a time-weighted average price. So you basically place an order and say, well, over the next day or two, I want to sell this much Ether. And then that trade actually gets split up into multiple smaller chunks, which execute over a certain time frame. Here in the screenshot, you can see that there was an order executed every hour. And this really allows you to do larger trades with very limited, or with minimal price impact. The smart contracts have been audited and used in production. So this type of order is ready to use. Unfortunately, we don't have a UI for it yet. If you're interested in making a TWAP trade, please feel free to reach out to us, and we can help you set up even without a UI until it gets available. The second type of smart order that I want to present here is actually a community contribution from the Yearn team. It has its code name Milkman. It was actually the order type that the ENS DAO ended up using for its trade. And what Milkman allows a DAO to do is to not set a fixed slippage tolerance at the time when the trade is being voted on or crafted, but instead defer the slippage tolerance to be a dynamic value based off some oracle at execution time. So instead of saying, take today's Ethereum price minus 20%, you can say, take whatever Ethereum's price is at the time the settlement goes through, minus 2%. So for that, you need to commit, instead of committing to a limit price, you're committing to a price checker, to an oracle. So that could be Chainlink, it could be Uniswap, TWAP, and basically say, at execution time, I'm making sure that the price that I'm offered is at least as good as Chainlink, or at least as good as Uniswap, minus some dynamic slippage. Then, of course, there's still, that's just a technical detail, there's some system that needs to translate that dynamic limit order into a concrete limit order that can actually enter our system, but that service can run permissionlessly. So the ENS DAO was running one of those services. The Milkman team ran one. Also, Cow Protocol runs one. Basically, that then translate these abstract limit orders into concrete limit orders.
Felix, this is Ed. We're just about out of time here for today, for unfortunately for the presentation, but this has been a great overview of the Cow Protocol. I was wondering if you had any advice for the audience before we go, in terms of next steps. Like if there's folks that are interested more about the Cow Protocol or want to get involved, what would you suggest for them in terms of resources to look at and places to go?
Yeah, so I mean, basically these smart orders are still early stage, so we would love to hear more use cases and have also builders look into creating some of those. We have a grants program where we support people that want to build on top of Cow Protocol. So for that, visit our grants page at grants.cow.fi. We're very active on Twitter. You can follow us on Twitter, or check out our contracts and code on GitHub directly. We have a Discord where we answer community questions, and yeah, it would be great to have people could contribute to this and help us not just become the best DEX aggregator for retail users, but also for institutional investors and DAOs.
Fantastic. We're excited about the future, Felix, and thank you for educating us on the Cow Protocol.
Thank you.
Coming up next, the co-founder of the Near protocol presenting about Near, and it's going to be an exciting chat. Near is one of the most promising kind of Web3 blockchains out there, and we're very lucky to have one of the